Cell 1. In this cell, we delve into the foundational principles that guide hedge fund strategies, moving beyond trendy jargon to focus on practical and actionable concepts. Understanding these principles is critical because they reveal how hedge funds operate in pursuit of consistent returns while effectively managing risk. First, we explore the concept of repeatable edge, which emphasizes the need for strategies that can be reliably executed over time. Hedge funds aim to identify and leverage anomalies in the market that can lead to profitable opportunities, and this requires a methodical approach. Next, risk control becomes paramount. It's not just about making gains, but also about minimizing potential losses. Hedge funds use rigorous risk management techniques to protect their investments and ensure that they can weather market volatility. Implementation details play a crucial role as well. This refers to how strategies are executed in the real world, which often involves timing, pricing, and execution speed. Understanding the nuances of transaction costs and market impact is essential for maximizing the effectiveness of any trading strategy. As we consider these 10 concepts, each is explained in straightforward terms, making them accessible even for those new to finance. This includes insights on market inefficiencies, leverage, and the importance of diversification in a hedge fund's investment approach. Recognizing that these principles are interrelated is key. A solid grasp of one can often enhance your understanding of another. Looking ahead, the next cell will likely provide deeper insights into specific strategies employed by hedge funds, illustrating how these foundational concepts are put into practice in a dynamic market environment. Through this transition, you'll gain a richer perspective on not just what hedge funds do, but why they do it, setting the stage for more advanced discussions. Cell 2. In this cell, we delve into the concept of edge in the context of investing, particularly focusing on hedge funds. The emphasis here is on the importance of the statistical validity of investment signals after accounting for costs, rather than just their theoretical appeal. This distinction is crucial, as successful investment strategies rely on persistent edge rather than clever storytelling. The essence of an edge is its performance over time in various market conditions, measured by its ability to generate returns consistently. We're not just concerned with strategies that perform well in backtests. We need signals that stand the test of time and unpredictability in live trading environments. This involves rigorous analysis, including out-of-sample testing, to ensure that a signal isn't simply a product of overfitting to past data, but rather a robust strategy that can adapt through different market regimes. When evaluating a trading strategy, the focus should be on specific metrics, such as win rates and drawdowns, which provide insight into the discipline required to execute a strategy effectively. Even a strategy that wins just over half the time can be significantly valuable if it is supported by a disciplined approach to risk management. It's also important to consider the friction in live trading, such as transaction costs and market impact, which can erode potential profits. Assumptions made in backtests must be challenged when applied to real-world scenarios, as market behavior often varies. As we transition to the next cell, we'll likely explore these concepts further, examining the specific methodologies that can help quantify and enhance this edge, ensuring that our strategies remain robust even as market conditions evolve. Cell 3. In this cell, we're diving into the concept of risk-adjusted returns, which is crucial for a more meaningful assessment of investment performance. It's essential to recognize that a seemingly impressive raw return, such as 20%, may not be as appealing if it comes with high volatility that leads to significant losses over time. Instead, a more stable 10% return is often preferable, especially if it comes with lower risk. We're looking closely at various metrics that help us understand the relationship between returns and risk. The Sharpe ratio, for example, gives us a sense of how well an investment compensates for the risk taken. The higher the Sharpe ratio, the better the return relative to risk. Similarly, the Sortino ratio focuses specifically on downside risk, providing insights into potential losses rather than all volatility. Other critical measures such as drawdown depth and duration allow us to analyze historical performance by showing how far an investment has fallen from its peak and how long it took to recover. Tail behavior examines the risks associated with extreme market movements, which can be pivotal for long-term investors, focusing on capital preservation. These metrics underscore the importance of surviving market fluctuations, as maintaining capital is the ultimate goal. This perspective shifts how we evaluate investments, emphasizing the need for a holistic view rather than simply chasing high returns. In the next cell, we will likely continue to explore these risk assessment techniques, possibly applying them to real investment scenarios or comparing different strategies based on risk-adjusted metrics. This will further help us appreciate why managing risk is just as crucial as striving for returns. Cell 4. In this cell, we're delving into the important concepts of drawdown control and recovery time in investment strategies. Understanding how severe losses impact investor behavior is crucial, as prolonged periods of drawdown can really shake confidence and lead to significant redemptions, often at inopportune times. We start by recognizing that even if an investment strategy is eventually successful, it doesn't alleviate the stress experienced during those tough periods. This is where drawdown duration becomes a vital focus. Many funds strategically aim to minimize the duration of drawdowns rather than solely maximizing potential gains. The rationale behind this is straightforward. Investors typically prefer stability over the possibility of higher returns if that path involves extended losses. When analyzing drawdowns, we need to look at key metrics such as the severity of the drawdown and how quickly an investment can recover from it. These figures help to quantify the risks associated with different strategies and highlight the emotional toll of long-term downturns. The variables at play here are not just numbers, they reflect real-world consequences for investors, both in terms of financial impact and psychological effects. In crafting a strategy, investors and fund managers must consider these elements carefully. It's essential to strike a balance between potential upside and the risk of facing extended drawdowns. As we proceed to the next cell, we'll build on this foundation to explore practical methods for measuring these drawdowns and developing recovery strategies that can provide a safety net. This will enable us to better formulate resilient investment approaches in the face of volatility. Cell 5. In this cell, we're diving into the critical concepts of position sizing and capital allocation, which play a pivotal role in the performance of any trading strategy or investment portfolio. Understanding how to allocate capital effectively can make the difference between a successful investment strategy and one that falters, even with solid entry signals. The text emphasizes that simply having a good trade signal isn't enough. It highlights how important it is to consider the sizing of each position, as poor sizing can thwart even the best strategies. Position sizing is essentially about determining how much of your capital should be put at risk on any single trade. This requires careful consideration of volatility targeting, which helps manage risk by adjusting position sizes based on the price movements of the assets in question. The mention of risk parity and Kelly fractions points towards sophisticated approaches that hedge funds utilize to balance risk across different investments. These methods ensure that the portfolio maintains a favorable risk-return profile, minimizing the chances of catastrophic losses. Concentration limits are another key aspect, as they help prevent overexposure to any single risk factor or investment, further safeguarding the portfolio's health. As we think about position sizing, it's essential to recognize the assumptions underlying these strategies. For instance, a trader must often assume that their market analysis is sound, and that historical volatility is a reasonable predictor of future price movements. Not acknowledging these assumptions can lead to significant pitfalls, such as potentially over-leveraging in a volatile market environment. In summary, this cell underlines that effective position sizing and capital allocation are not just technical skills, but foundational elements that can enhance an investment strategy's longevity and success. Moving forward, the next cell will likely build upon these concepts, offering insights into implementing these principles in real-world scenarios. Cell 6. In this cell, we delve into the critical concept of correlation in investment strategies, specifically focusing on how strategies perform during turbulent market conditions. This aspect is vital because a truly diversified portfolio should provide protection when it's needed most, not just when the market is stable. First, let's consider what we mean by conditional correlations. They essentially measure how different investment strategies behave in stressful environments, rather than under normal market conditions. This distinction is crucial. Imagine a scenario where you think you're diversified, yet when the market takes a downturn, all your investments drop simultaneously. If that happens, your diversification strategy fails to protect your assets, undermining its intended purpose. We're aiming to identify strategies that not only appear diverse on paper, but actually demonstrate resilience in challenging times. This involves analyzing how various strategies respond to market stressors. If we find that all chosen strategies collapse together under pressure, they're not providing the safety net that investors hope for. It's about ensuring that during market downturns, some investments provide a counterbalance to losses in others. As we look at the analysis, key variables will likely emerge that inform us how these strategies interact under duress. Paying close attention to these relationships can offer valuable insights into crafting a portfolio that truly stands the test of time, particularly in adverse conditions. Importantly, one should always remember that historical performance is not indicative of future results, so assumptions made in this analysis should be taken with caution. Moving forward, the next cell will build on this foundation by exploring specific strategies and quantitative measures that will enable us to assess their conditional correlations more effectively. By using this framework, we'll gain a deeper understanding of how to create a genuinely robust investment strategy that withstands the inevitable stresses of the market. Cell 7. In this cell, we're delving into the concept of regime dependence, which is crucial for understanding how various trading strategies perform under different market conditions. The core idea here is that not all strategies are effective across the entire spectrum of market environments. This recognition serves as a cornerstone for hedge funds and other market participants as they navigate complex financial scenarios. As we explore the nuances of market regimes, such as high volatility, low interest rates, or inflationary periods, it becomes clear that these conditions significantly influence strategy effectiveness. Hedge funds don't just stick to one approach forever. Rather, they proactively monitor the macroeconomic landscape. This adaptability is vital because what may have been a successful strategy in one regime could quickly become a liability in another. The code behind this analysis likely involves gathering data on various market indicators and correlating them with historical performance metrics of different strategies. Important variables in this context could include measures of volatility, interest rates, and other macroeconomic variables that determine the current regime. By comparing these factors, the system can identify which strategies are likely to thrive or falter under specific conditions. Understanding this principle is not only about recognizing the importance of adaptability, but also about developing a mindset that anticipates change. One common pitfall to be aware of is the assumption that a winning strategy will always be effective. Market dynamics can shift unexpectedly. Therefore, ongoing assessment and adjustment are essential. Looking ahead, the next cell will likely build on this foundation by introducing specific metrics or analytics to quantify performance across different regimes, thereby providing more granular insights into strategy effectiveness. This deeper dive will help us formulate a more robust approach adaptable to varying market conditions. Cell 8. In this cell, we're delving into a critical aspect of trading performance: execution quality and slippage. It's essential to understand that strong returns on paper can quickly vanish if the execution of trades is subpar. Here, we're considering various factors that influence the actual trading process, including the bid-ask spread, market impact, fill rates, latency, and venue selection. The bid-ask spread represents the difference between what buyers are willing to pay and what sellers are willing to accept. A narrower spread generally means lower trading costs, which is beneficial for capturing profits. Market impact, on the other hand, refers to the effect that a trade can have on the market price of a security. Large trades can move prices significantly, leading to less favorable execution. It's crucial to be mindful of fill rates, which tell us how often the trades are executed at the intended price. Low fill rates can leave a trader exposed to changing market conditions, leading to potential losses. Then there's latency, which is all about speed. In fast-moving markets, delays can result in missing optimal execution opportunities. Venue selection considers where trades are executed. Different exchanges can have varying fees, liquidity, and execution times. By factoring in all these elements, we gain a richer understanding of the trading landscape. It becomes evident that achieving a small edge is often more valuable than having a large edge if the execution is poor. As we move forward to the next cell, we'll likely explore how to optimize these execution parameters and mitigate risks, enhancing our overall trading strategy even further. This examination will deepen our appreciation for the intersection of theory and practical application in trading. Cell 9. In this cell, we're diving into the essential concepts of capacity and scalability within investment strategies, particularly in the context of hedge funds. Understanding these factors is crucial, because a strategy that works effectively with a smaller capital, say $10 million, might encounter significant challenges once scaled up to $500 million. This isn't just about greed or ambition, it's about the fundamental mechanics of financial markets and how they respond to increased investments. As hedge funds manage more capital, they need to assess the point at which their strategy can start to produce diminishing returns. Essentially, the question revolves around identifying capacity constraints. Enjoying a larger pool of capital can seem advantageous, but there's a tipping point where the influx might actually hurt performance. This consideration is not merely an afterthought. It's a critical factor that can dictate whether a strategy remains viable or becomes too risky to pursue further. In evaluating capacity, hedge funds typically look at market liquidity, the nature of the assets involved, and the competitive landscape. For example, certain strategies rely heavily on niche or illiquid markets, where investing too much can drastically alter the dynamics, affecting prices negatively. The key takeaway here is that just because a strategy shows promising returns on a smaller scale does not guarantee that it will succeed when larger sums are deployed. As we move forward, it's important to think about how these principles of capacity and scalability influence decision-making in investment strategies. The next cell will likely explore ways to evaluate and mitigate these risks, providing tools and methodologies to optimize strategy performance while considering capacity constraints. This understanding will equip you to make more informed decisions as we delve deeper into strategy development and risk management. Cell 10. In this cell, we're focusing on the vital concept of risk of ruin and tail exposure, particularly how these factors influence financial decision-making. It's essential to understand that managing risk, especially in extreme scenarios, can be even more crucial than seeking small gains. We often think of investment as a long-term endeavor, yet without effectively navigating worst-case scenarios, any potential growth can be severely undermined. Here, we're exploring the importance of explicitly modeling those dire situations, including market crashes and liquidity freezes. The reasoning behind this analysis is straightforward. If we don't account for the potential for catastrophic losses, we may find ourselves unprepared when they occur. In the finance world, survival is key to compounding returns over the long haul. After all, if you can't weather the storm, any gains achieved in calmer weather become irrelevant. Variables such as market volatility and correlation spikes play a significant role in this analysis. It's not merely about assessing typical performance. We also need to consider how assets behave under stress. The process of modeling these extreme scenarios helps investors craft strategies that prioritize durability. One key assumption here is that the worst case is not just a theoretical exercise, but a definite possibility that must be accounted for. As we continue our journey, the next cell is likely to delve deeper into strategies for risk management, providing concrete methods to mitigate these extreme risks. By focusing on survival and resilience, we lay the groundwork for sustained growth, ensuring that we not only aim for alpha, but also safeguard our capital against unforeseen downturns. Cell 11. In this section, we delve into the critical concept of process repeatability and discipline in the context of hedge fund strategies. The focus here is on the importance of consistently executing a strategy, unhindered by the emotional factors that can influence decision-making. This aspect is particularly significant because the financial landscape is inherently volatile, and even the most innovative strategies can falter when they're not applied rigorously. A key idea is that a seemingly less impressive strategy, if implemented with unwavering discipline, can yield better results than a superior strategy that is inconsistently executed due to human emotions or external pressures. This points to a vital lesson for anyone involved in trading or investment. Adherence to a well-defined process can often lead to more reliable outcomes than relying solely on instinct or past performances. One of the major variables highlighted here is the concept of emotional control. When traders face unexpected downturns or successes, their judgment can waver, potentially leading to rash decisions that compromise the integrity of their strategy. By emphasizing disciplined execution, hedge funds aim to mitigate the risks associated with these emotional influences. As we explore this topic further, we begin to appreciate the foundational importance of a structured approach in finance. The implications of process repeatability extend beyond mere strategy. It touches on the broader themes of risk management and decision-making in high-stakes environments. In the next cell, we will likely build on these principles, exploring specific tools or methodologies that can be employed to maintain that critical discipline within trading practices. Cell 12. In this cell, we're diving into the critical relationship between returns and risk management, illustrating how losses can impact recovery and overall investment strategy. The key takeaway here is that while returns can attract capital, effective risk management is essential to protect those gains. We start by understanding the asymmetry of losses. If an investment experiences a decline, the percentage needed to recover is disproportionately high compared to the initial loss. For instance, a 50% drop in stock price doesn't just require a modest gain to break even. It demands a full 100% increase to regain lost ground. This showcases the harsh reality that professionals in the field pay close attention to drawdowns, as they significantly affect an investor's journey. The cell highlights specific loss percentages, each paired with the required recovery percentages. A 10% loss might seem manageable, but it still demands an 11.1% gain just to return to square one. The deeper you dig into these figures, the clearer it becomes how quickly compounding losses can turn into serious hurdles. A 30% loss needs a nearly 43% gain to recover. A 75% loss balloons to an incredible 300% recovery requirement. These dynamics lead us to consider portfolio management strategies. While aiming for a consistent return of 8% to 10% with minimal risk exposure is a more straightforward goal, not managing your risk adequately can lead to scenarios where significant losses complicate matters. For an investor with a substantial drawdown, achieving a recovery may feel not just daunting, but almost insurmountable. Looking ahead, the next cell will likely build on this foundation by exploring practical strategies for managing that risk more effectively, examining tools and approaches that can help investors mitigate potential drawdowns while still seeking attractive returns. This way, we can better understand how to navigate the sometimes turbulent waters of investment. Cell 13. In this cell, we're wrapping up our analysis, summarizing the key takeaways from our work. It's crucial to have a clear ending point, as this gives us an opportunity to reflect on what we've accomplished and ensures that we understand the implications of our findings. As we consolidate our results, we focus on the primary arguments we've gathered. We've conducted comparisons and analyses throughout, and now it's time to consider how all these elements fit together. The main variables we've explored will help us understand the underlying trends and patterns in our data, and our conclusions will be based on the insights revealed by these comparisons. One of the most critical aspects we've tackled is ensuring that our findings are robust and reliable. We've taken care to handle possible pitfalls, such as data inconsistencies or assumptions that might skew our results. Being aware of these issues strengthens our conclusions and helps us advocate for the right decisions moving forward. Looking ahead, this closure sets the stage for the upcoming cell, where we'll likely discuss how to implement these findings in practical scenarios or further refine our understanding with additional data sources. This transition is not just a conclusion, but a stepping stone towards deeper exploration and application of the insights we've gained.